Traditional budgeting apps functioned as descriptive ledgers. They categorized past transactions, but relied entirely on your manual discipline to actually save whatever remained. But the financial sector is moving toward agentic AI. These systems have evolved beyond simple tracking to forecasting your needs and moving capital autonomously without requiring your continuous oversight. This diagram illustrates the safe-to-save pipeline, the engine behind the shift. The AI monitors your income against upcoming bills to identify unallocated cash. When the algorithm detects a surplus, even $14.22, it immediately sweeps that capital into an interest-bearing account. This methodology successfully decouples wealth building from human willpower. It serves as an automated system where accumulation happens in the background, provided the cash flow math stays positive. For consumers who struggle with manual budgeting, the benefits are immediate. You build an emergency fund automatically, potentially escaping the paycheck-to-paycheck cycle without having to change your daily habits. However, surrendering liquidity management to a machine introduces risk. You are trusting a black box algorithm to accurately calculate your liabilities, hoping it doesn't extract money you actually needed for essential survival expenses. There is also a psychological cost: learned financial helplessness. If an app handles every calculation and spending limit, your organic financial literacy and ability to manage resources intuitively can begin to atrophy. That creates an essential dilemma. You must decide if the convenience of algorithmic resilience is worth the risk of losing direct, intuitive control over your own financial reality. To forecast your needs, these AI models analyze 30 to 90-day transaction sequences. They map out the timing and the likely amounts of your recurring bills based on your historical spending cadence. But predictive models aren't perfect. We saw the consequences when the Consumer Financial Protection Bureau took enforcement action against the app Hello Digit. Digit's algorithm failed to account for edge case spending anomalies and processing delays. The AI extracted funds users required for survival, triggering thousands of overdraft fees for people who were told their accounts were safe. This failure led to the industry-wide adoption of manual guardrails. Apps like Oportun now allow you to set a safe saving level, a hard minimum checking balance that the algorithm is forbidden from crossing. Because predictive machine learning can produce errors, human-defined constraints are the only true failsafe against algorithmic mistakes that could drain your checking account. The actual utility of these AI money coaches depends on where you live. Geography dictates how efficiently these agents can access and move your capital. This comparison table shows the landscape in the United States, where aggressive feature consolidation is common. Accessing autonomous coaching usually requires joining a proprietary ecosystem and paying a premium monthly subscription fee. This shift reduces the traditional checking account to a dumb pipe, a place where your payroll lands before being moved elsewhere by an agent. This is a threat to legacy banks. The moment an algorithm detects idle cash, it can sweep that capital into a high-yield competitor, depriving traditional banks of the low-cost deposits they use to fund their operations. This same granular cash flow data is also changing how credit is issued. By analyzing your income cadence and surplus predictability, platforms can extend cash advances without a traditional credit check. They use your real-time behavior to determine if you can safely repay a short-term loan. This provides immediate liquidity, but it creates a new trade-off. You get the cash you need today, but you aren't building the systemic credit history required to secure a mortgage or a major loan in the future. To decide if these tools are worth it, you have to look at the math. The economic utility depends entirely on the relationship between subscription fees and your capital yield. This chart visualizes the economic tension. Saving $1,000 at 4% interest yields $40 annually. But if the app costs $10 a month, you pay $120, a net loss of $80. For a $15 fee, you must maintain a $4,500 balance just to break even on costs. This mathematical reality defines the behavioral tax. The monthly subscription fee pays for psychological scaffolding and forced discipline, rather than functioning as a pure wealth-building tool. For lower-income users who struggle to save or frequently face $35 overdraft penalties, this negative financial return is often a worthwhile price to pay for the safety of finally building an emergency buffer. Choosing the right AI money coach requires you to segment your financial profile against the cost of that behavioral tax. We map this on a quadrant chart: need for behavioral scaffolding versus willingness to pay. For heavy automation, high-fee apps like Cleo, Albert, or Plum Max provide forced discipline. If already disciplined, use fee-free hubs like Origin or Chipped to maximize yield. Agentic AI is an effective tool to build initial resilience. But as your savings grow, you must eventually graduate to optimization-focused tools to ensure the algorithm works for your wealth, not just taxes it.